All right. Good afternoon, ladies and gentlemen. Many thanks for joining us. Thanks to Kevin and Andrew for inviting me to spend 15 to 20 minutes to talk to you around some of our thoughts around the outlook for offshore energy, a bit of a focus on the offshore marine markets. I'm going to talk a little bit about 2024 for a bit of context, and then I'm going to talk around our thoughts on some of the headwinds we're expecting to see in 2025, but also some of the more positive stories as well. So hopefully this works. Yeah, okay. I'm going to have to turn my head so I can keep an eye on the slide. So I'm going to start just with a bit of a summary of 2024. And I think as we all know, anyone who's involved in this industry, 2024 was fundamentally a very solid year when it comes to offshore energy and offshore oil and gas. If we look at some of the key macro fundamental indicators that we've kind of output here, we can see that we had an average Brent oil price of just north of $80 a barrel, which is pretty solid and very much conducive to new investment in new projects. And fundamentally, we had a relatively tightly balanced market. So those gray bars in the first chart, that's showing the over-under for global crude oil supply and demand. And fundamentally, when we're within 1 million barrels a day, we're pretty much well balanced. And of course, as we all know, that's largely due to the continued efforts of the OPEC Plus bloc, who continue with their interventionist strategy, keep markets balanced and to keep oil prices robust. And that robust oil price of $80 a barrel, again, that was supportive of significant levels of investment into new projects. And the second chart is taken from our data, and this is investment into new offshore EPCI spend. So this is spending on new production infrastructure, floating production systems, fixed production systems, pipelines, SURF, all of the things that we need to develop new oil and gas. And we've broken it out by Asia Pacific and the rest of the world. So you can see that Asia Pacific was in that lighter blue, was a pretty significant contributor to the spend. And in 2024, we had around 65 billion of spend, which whilst a little bit lower than 2022, you've got to take that 2022 number with a pinch of salt, because that was to a large extent a reaction to deferred projects during the COVID era. So a robust year with regards to spend and macro fundamentals last year, but it was very much a tale of two halves. So the first half was very strong. We started to see some of these more negative narratives creep in as we moved into 3Q and 4Q. And one of the first charts I've used to indicate this are rig counts. So this is all offshore rigs, well, MOJUs, I should say, so jackups, semis, and drill ships. So no tenders, unfortunately, in that chart. And you can see that globally, as we moved into the second half of the year in that gray line, we started to see a bit of a reduction in the working contracted count. And it's kind of been talked about a little bit, some of the reasons there. Primarily, we saw the suspension of 31 to 33, depending who you listen to, jackups from Saudi Aramco, which has had a big impact there. And that's really created a softness in the jackup market. Many of those rigs finding a home in Southeast Asia, but many still looking for work. But also worth noting that in the APAC region, again, following up from something that was mentioned in the last discussion, we have seen very robust levels of activity, and we have seen a continued increase. But outside of the APAC region, we are starting to see a more negative narrative creep in 2025, which is causing some concern. So what are the things that we're looking out for as we go into 2025 and we think about what's going to shape spend in offshore oil and gas? Well, one of the key things that's really driving the uncertainty at a macro level is the softening of Chinese crude demand growth. First chart here is showing monthly crude imports into China in million tons. So those are the gray bars. And it's quite hard to kind of pick that out because, of course, it is quite choppy kind of month to month. So in that blue line, we put the trailing 12 months, which shows kind of a good trend line. And you can see that as we've kind of moved, see if the laser works here. Yeah, as we've kind of moved into the back end of last year, that kind of average or that trend has started to soften, which has been one of the key kind of canaries in the mine shaft when it comes to crude oil markets. And a lot of this has been levied against the faster than expected rise of electric vehicles, which is certainly part of it. But probably what really took people by surprise was the rapid ascension of LNG trucking. So this is the use of LNG fuel into long distance road logistics, which is something we did not think was going to happen in the time frame that's happened in China. And that's really now led to a situation where we now believe as a consensus industry that diesel has now peaked. Diesel demand in China has peaked, whereas crude will continue to grow, but largely driven by petrochems. So China being the main engine of oil demand growth for the past 20 years or so, what has that meant for our short-term views on oil demand? And this second chart is looking at changing or evolving views on 2025 oil demand by OPEC and the IEA. And the key trend here, looking at OPEC, is as we've kind of gone through the year from May 24 to Jan 25, they've continually revised down their expectation for 2025 crude oil demand, kind of in line with what we've seen in the first chart. The IEA has been a bit of a different story. They're always a little bit revisionist, maybe a little bit more. Let's say OPEC are a little bit more consistent in their bullish views on the sector. But fundamentally, the trend here is that we are expecting a softer 2025 with regards to oil demand growth than we had been expecting maybe 12 to 18 months ago. So what does that mean for oil supply and demand balances and effectively the crude oil barrel as well? So this last chart is really kind of showing the impact of the OPEC Plus bloc with the more recent voluntary cuts. So in early 2023, in addition to the cuts that were already in place by the OPEC Plus bloc, led by Saudi Arabia, we saw an additional voluntary, just shy of 2.2 million barrels a day of crude come out of the market, which is kind of shown by those green lines here. So this is starting in Jan 2023. We can see the barrels that have been taken out of the market by the OPEC Plus group. But what we have also seen is that for every barrel, effectively, that they have taken out of the market, the international community has put a barrel back in. So we've seen some of the biggest additions to crude supply. That's coming from US liquids, that includes NGLs, but of course US crude peaked at around 13.6 million barrels a day at the back end of last year, which no one really expected it to do. Iran, which could obviously be impacted by sanctions, Guyana and Brazil. These have been the biggest contributors to crude growth, and we've really seen a complete offset of the very significant efforts of the OPEC Plus bloc to create a balanced market. And as a function of that, whilst Brent has remained relatively robust, we have seen this kind of downward trend. So we saw an average of about 80 last year. We're probably expecting that to soften over the course of 2025. Again, at the moment, we're in a kind of battling in a $70 to $75 a barrel range. And given where we are at the moment and the fact that OPEC has said now that it is planning to start to unwind to 2.2 million barrels starting in April, we expect it to continue in that $70 to $75 a barrel range, although caveating, of course, that OPEC Plus will be evaluating the market on a month-to-month basis. So a slightly softer year from a macroeconomic perspective. Our view on oil prices, really just summarizing what I've just said, we expect this year to be at around 70, 75, but we do expect fundamentals to kind of reassert themselves as we move into 26 and 27 and have a slightly stronger market in those years. So what does that mean in terms of spending? So you've got a slightly longer outlook with regards to offshore EPCI spending activity. You can see what we had previously. We expect a slightly muted 2025, again, slightly muted again in 26, although still robust, still significant amounts of investment, it should be said, before a bit of a pickup in 2027. Now, of course, no real surprise in recent years, the spending has been driven by the Arab Gulf states and by Latin America, and we largely expect that to continue over the next 12 to 24 months as well. We have a bit of a shopping list of equipment that's going to be installed between 25 and 27. You can see that's 35 additional floating platforms, production platforms, 15 of those in LATAM, 311 fixed facilities, 213 of those across the GCC, and around 11,500 kilometers of pipelines, around a third of those actually in the APAC region. This will be a significant contributor to pipeline installations over the next couple of years. So despite some of the weakness in the macro story, we still see a need for investment in new projects. And again, this is very much on a project-by-project basis. But of course, oil and gas is not the only story in town. We've had a really good discussion about how a lot of the shine has come off the energy transition, and in particular the offshore wind story, which has seen a very challenging commercial environment over the past 18 months, as you've seen the cost escalation in oil and gas. But you can see here what we've done is kind of map the similar kind of spending in offshore EPCI for oil and gas, the comparable spending for wind, and also looking at offshore power, which is effectively interconnectors, and what we would call new energy. So this is investment in carbon capture and hydrogen projects offshore. And again, in this part of the world, we've seen pretty significant high-profile projects for carbon capture in Malaysia already and likely in Thailand in the next 12 months or so. So relatively small, but an emerging and very interesting market for all the contractors in the region. Allows you to really kind of flex your green credentials, be part of the energy transition, but do what you're good at. Rather than have to change your business plan to start thinking about wind turbines, you can lay pipelines, you can build and install fixed facilities, and you're very much firmly leading the energy transition story in carbon capture. But the numbers at the bottom is probably what's most interesting here. So we've grouped the spending into periods of 5 years, and you can see obviously we had this significant growth from 519 to 2020 to 2024. But in those years, oil and gas, this dark blue area, still retaining its dominant share. It dropped from 77% to 66%, I think that is, with wind kind of emerging a little bit. But it's really over the next 5 years where we expect to see a significant transition, with oil and gas dropping to 43% of that spending and offshore wind at 50%. So whilst a lot of the shine has come off the wind market and we have reduced our expectations for investment in offshore wind, it will still be a huge industry with huge amounts of turbines and capacity being delivered by the offshore energy sector. Just a quick look at the drilling market as well and what we're expecting there. And I guess the kind of consensus coming from some of the previous charts I showed up and in the industry now is that the back end of last year was becoming increasingly challenging. Now, we talked about the jackups and the reason there, with around 31 to 33 jackups being released by Aramco, looking for new homes, and that's why you've seen kind of the dip in this market. In the drillship market, you're seeing kind of similar struggles. What you've seen in the last 12 months is the reactivation, or at least the delivery, of a number of drill ships from yards in Korea, which happened maybe a bit quicker than people expected, which has now created a sudden a bit of an oversupply in that segment, when coupled with the fact that many of the bigger contracts are now being delayed and pushed to the right. So what you're really seeing across most of these markets is an actual softening of contracted counts in 2025, almost across the board, which is going to bring down committed and contracted utilization rates, which is, not something we were probably expecting 12 to 24 months ago. But as we saw in some of those previous charts, and in line with our views that macroeconomics will realign in 26, we do expect this to correct itself. So as we move into 26 and 27, based on expected drilling campaigns and the timings of those campaigns, we do expect those counts to increase, with drill ships moving back up to kind of 82 to 86 contracted counts by 2027. So whilst, again, a bit of softness expected in the next 12 months, we do think this is something that will sort itself out in the kind of mid to long term. But one of the key issues that, again, has been touched on here, and I guess this is more thematic, and one of the reasons why we are seeing increased delays, is this question now that is the industry, the offshore energy industry, broken? And that sounds a little bit alarmist maybe, but it's touching on all of the points. We have seen, if we think about kind of phases in the upstream cost cycle, we had this period from kind of 11 to 14 where we had very high oil prices. We had a structural oil price of around $110 a barrel. And with that, we had very high industry costs. We had day rates for drill ships, 550 to 600,000 a day. And we had record rates for offshore support vessels as well, and all types of equipment in the sector. We then, of course, had the oil price collapse, and we had a period of realignment where we had very low prices, but we still had quite high industry costs, and everyone was struggling, and cash flows were negative, etc. The industry realigned from around 17 to 19. We still had relatively low oil prices, but we had realigned and rationalized the costs. So effectively, we had low prices and low costs. It wasn't a very interesting sector, but it was more balanced. We then had the rapid rise in oil prices that came kind of post-COVID. And we still had those low industry costs in place. And that was, of course, was fantastic for the E&P community. And we posted record levels of cash flows because we were able to really, really kind of take advantage of those growing oil prices with very low levels of industry cost. Where we are today is a situation where industry costs across the board are creeping up to what they were in 2012 to 2014 for rigs, for boats, for subsea infrastructure, for FPSOs, really kind of across the board, but we do not have the oil price or the structural oil price to support that level of pricing. And this is one of the key reasons why today the industry is a little bit broken. This is why we are seeing the E&P community increasingly challenged to get new projects sanctioned and delivered on budget. It's why we're seeing projects deferred and slipped to the right, which is why we're seeing a slowdown in levels of activity and contracted rig counts, and then subsequently the offshore marine sector. So it's really this situation we're in now where we're going to have to see a new realignment, in our opinion. Costs and pricing, we've really enjoyed it. We've enjoyed this bubble that we've kind of lived in, I think, for the last 12 to 18 months, but we will expect to see some more downward pressure placed on pricing across the board as the industry has to readjust to a $75 to $80 a barrel Brent. So just a bit on the OSV sector, just given that's kind of the key theme here. And it's really kind of going over a lot of the themes we saw in the rig market. It's just from the vessel perspective. And this first chart here is showing total utilization, which includes all boats, including the layups, and the effective utilization, which then excludes the laid-up fleet. And of course, we've seen what happened in the down years. We saw this rapid improvement in utilization rates, and again, we've seen effective utilization at around kind of 75 to 80% at the moment. But of course, the leading contractors, when you remove a lot of the single vessel guys and some of the less attractive markets, typically those guys will outperform the average. But even those guys, when we take the top 10 owners, the top 10 largest owners in the OSV sector, whilst of course they've been averaging over 80% in the last several quarters, we have seen a downward trend in their utilizations as well, for a lot of the reasons that I've mentioned, with the rig market softening and a slight slowdown in some of these project sanctions. What that meant for rates, of course, we've seen a similar kind of massive trajectory and improvement in day rates for both anchor handlers and PSVs. So we're tracking the anchor handlers on $1 per brake horsepower, so we can normalize. We first saw the massive improvement in Brazil, but most of the other regions followed suit very quickly, and a similar story for the PSVs, where it's $1 per meter squared of deck. But what we're now seeing is that slowdown. We've seen last year we saw kind of a more of a plateauing in those rates, and now we're starting to see even that plateau be challenged, and we are starting to see those rates probably come down and soften over the course of 2025. And it's important to remind ourselves, we're not looking at a crash here. We often complain of the oil and gas sector being cyclical. It's either too hot or it's too cold, and it's impossible to plan, and we can't really have any... Yes, please. Yeah. And we can't... sorry, we're up or we're down. And what we're seeing now is more of a Goldilocks zone. We're seeing more of a situation where we may have a balanced market at $70 to $80 a barrel, but this is what a balanced market looks like. We can't expect to have our cake and eat it. We can't expect to have a balanced, stable oil market, but also have industry pricing where it was in the boom and bust period. And really, that's all I had for you today, so I'll leave it there for the next panel discussion. Thank you.